to the On the Horizon podcast, Buying and Selling Businesses, brought to you by Horizon Business Brokers, your trusted guide to buying, selling, and valuing businesses. Your next opportunity is just on the horizon.
Hello. Dustin Zaire here with another episode of On the Horizon. I have a very good friend with me today and fellow Caps fan, Thrine Harpering, with Cover Your Accounts. He is a bookkeeper and is our personal bookkeeper at Horizon Business Brokers. Thrine, welcome.
Well, thanks, Dustin. I have to say that intro is pretty professional. I love it.
Thank you. I appreciate it. So, Thrine, I'm grateful for you joining today, so we can have you share some good advice and some common topics of discussion as business sellers are looking to kind of prepare their business for sale and what they can do to get the most value from the sale of their business, right? But before starting, I'd love for you to take the opportunity to introduce yourself, your professional and business background, and how long you've been providing accounting and bookkeeping services. And then we can kind of dive into some questions.
Yeah, I appreciate that. So, I mean, the first thing that most people ask about my name, right? So Thrine, where'd that come from? Usually people mess it up and call me Brian or Ryan. I like it when they mess it up and call me Thor. Like, I don't mind that one. But it's a family name, so it's German. It's my grandmother's maiden name. And I've been in the accounting business for 30 plus years with a lot of different companies. And I started this bookkeeping / accounting firm. Oh gosh, it's been 4 years now. So, and then I met you a couple of years ago. And gosh, I wish I would have opened the firm, a couple of years out of college, but that's the way life goes, and decided to do my own thing later in life.
Cool. No, that's awesome. And it's been great working with you and your team. So, first and foremost, like, what is the main difference between an accountant and a bookkeeper, right? Because we're going to be having an accountant on our podcast here in the coming weeks, somebody else that you and I both know personally and work closely with. But what is the main difference between an accountant and a bookkeeper, and why should a business owner have both?
Yeah, so here's the way I would sort of term it. I think business owners ultimately have to have 5 key financial people that they can talk to. In this case, your question, you're talking about bookkeeper and an accountant. I look at it a little bit differently, as bookkeepers can be accountants too. And there are different levels of bookkeeping, right? There are the green bookkeepers who their job is to categorize things appropriately and make sure your books are clean. That's their main job, is in reconciling the balance sheet accounts. That's their job. An accountant or certified public accountant, like our friend who's coming on next week, Brian, their firms focus on tax, which we don't do. We do not do taxes. We do bookkeeping and higher level accounting to make sure the books are clean. And his firm will also do other items, larger reviews, compilations, audits. And that's more in depth from an accounting perspective. But the main differences between Brian's firm and I, where we make sure we categorize everything and the books are clean appropriately based on GAAP principles. And he's going to come in and do the tax accounting and to make sure that your business's taxes and everything is, up to par, as well as anything else that will help your business succeed besides taxes.
Yeah, no, that's great. And
yep.
It's good to have, a professional handling, each of those things.
Yep.
It's great if those professionals are within the same firm, but that's not always the case. We
Sure.
have your firm handling our bookkeeping, and we have Brian's firm handling our accounting.
Yep.
And you guys are going into into extreme details to make sure that all of our accounting and bookkeeping is correct and we're getting the best kind of tax treatment, right? So so as we move forward and really kind of dig into the financials, right? We all have talked about, and our audience has heard us share and state many times, it's the financials that really matter, I would say, most when determining value out of a business and getting the best price, right? What is your opinion? Like, what financial numbers matter most to you? And then the second question that's going to follow up to that would be, what are buyers asking for first, right? So which largely financially driven, I would imagine, in your eye.
Yeah. So from a broad picture, there's really two main financial statements that matter to bookkeepers and fractional CFOs: the profit and loss statement or the income statement and the balance sheet. Those are the two financial indicators that business owners, buyers want to look at. The other thing that is probably the most important is the business generating cash, because buyers want to, as if I were buying a company, I'd want to know that I'm getting my return on investment back as soon as possible. And the only way you're getting that back is, as the business produces cash. So the cash flow statement is another statement that can be generated out of an accounting program, although it's not easily deciphered for smaller business owners. So it has to be put in terms that they can understand. And that's where someone like myself or Brian would come in, or you as a broker have that knowledge and be able to explain it to them. Those would be the cash flow statement is sort of underlooked, but a really important tool. So business owners, buyers can feel comfortable with what they're going to buy a business for and have that return on investment.
Yep. No, I agree. And having them in order, for at least, like how many years would you say that somebody should, make sure that their financials are, clean and organized?
Yeah, I would think at least the past couple years, like maybe 2. If you're going beyond 2, like buyers really, they're concerned because they want to have the historical value to make sure it's accurate and they're buying something that's in a good position at that time. But what they really should be focused on is the future. What's the business going to do for them in the future? So it gives a good basis. So I would say you got to be clean for at least 2 years. Going back more than that, that's great. But so many things are so flexible and change in the business environment within a short amount of time, and depending on what type of business and model you're trying to look to purchase. I think 2 years is really clean books for 2 years is really sufficient.
Cool. No, I would agree with that statement. I mean, when we try to prepare our clients for sale and when we're doing our analysis and business valuations and working with most lenders, there's certainly some lenders that are only concentrated on the most recent 2 years.
Right.
But I have found that generally it's 3, right? 3 to maybe 5 at most. But, when you're beyond 3 years, like, that's really like an old historical trend. The economies have usually changed, supply chains have changed, right? So your margins have changed, most likely, or hopefully not, right? Like, I think that's one of the wise things about having, a bookkeeper or a professional accounting firm is to, help you look at your financials on an ongoing basis to say, hey, like your revenues are still stable. We'll make up a number at $1 million in revenue. Mm-hmm. But your cost of goods have gone up and your labor costs have gone up. So your profit has gone down, right? Yeah. So if like the bookkeeper is helping provide these monthly reports, and you're meeting with your bookkeeper or accountant on kind of a quarterly or maybe biannually basis at the minimum, and you can kind of kind of track these trends that are happening within your own business to say, hey, like my revenues are fine, but my cash flow is going down or my profit is going down. Well, why is that? Right. And I think, correct me if I'm wrong, you guys can really dig into these metrics to say, hey, look, like based off of maybe some other similar types of businesses, the cost of goods should be, whatever, 25 or 30%. And now, you've slipped down to, 20%, right? So you can say, hey, we need to adjust our pricing, right, to maintain the margins that we were previously seeing, right? So,
and you bring up a good point. I mean, if you're seeing that happen over the period of time, and then something's wrong, right? Either they're not being able to control cost, or maybe they're growing. They want to get some more items, people to help, or they're bringing in another product line. But you've got to have that. You've got to have that difference. And if you don't have that profit, bottom line profit, and as you had mentioned in some of the notes you gave me prior to the meeting, EBITDA. I mean, you've got to watch those numbers routinely. And yes, we do that. Sure, we do that from a reporting perspective. But that also brings up one of my other critical individuals that you need to have in your pocket somewhere. Maybe they don't work for you full time, but you need to have a fractional CFO or someone who can really dig into the numbers. We do meet with clients monthly, and in some cases quarterly. But yeah, you need to have that. And maybe the broker, someone like you, who's got some great knowledge, can explain that to clients as well. So as long as you have someone on the team to be able to explain that and go through that, then the buyer and or the seller, because I mean it's a group, it's a team effort when the transaction goes through. It's important.
Definitely. So in addition to the P&Ls and the balance sheets and this cash flow statement, I do have buyers commonly ask for cash flow statements, but they aren't as well kept or as understandable as like a P&L and a balance sheet may be.
Right.
What are some other early due diligence items that you typically see requested? In addition to the P&Ls and balance sheets and cash flow statement?
The financials are what they are. I mean, it's sort of black and white. I mean, there are certain rules to follow. And if your books are clean, those are going to be, the buyer, and in this case, we're talking the seller too. Those are what they are. But the other thing that I think would be really important is, what's your customer mix look like, and how much revenue your customers are bringing in. Is one customer bringing in, 70% of their revenue, which could be a risk. So it's really looking at the sort of outside the financial scheme a little bit, and the contracts. What type of contracts do you have in place? Do you know that this is going to be an ongoing business and you're going to have revenue coming in? And again, it depends on the type of business, whether it's a bookkeeping firm that may have contracts, or an accounting firm that may have contracts with customers, versus more of a retail space where you're a brick and mortar. You don't really have contracts. You have people coming in because that's where they go to buy their products or service.
Yep. No, I think you bring up a good point, right? Customer concentration can be huge for any business, right? But yet alone a business that has, a small mix of clients, and, you have one client that, might be generating, 50, 70%, or more of the company's revenue. If that client is lost, it could be detrimental, right?
Yeah.
Is there in your mind, obviously 50, 70% of, customer concentration would be huge, but is there a general rule of thumb that's like, hey, if it's 10% or less, or 20% or less, is that as much of a red flag, or is that kind of maybe pretty common to have a client that makes up 10 or 20% of a business?
I think that's a good question. I don't know if there's a rule of thumb. I would say if a client is generating, I just off the top of my head, because I'm not digging into these numbers all the time, I would say if you have a client that's over 40%, then you got between 30 and 40%, then that's a big chunk of your revenue coming in. And in that case, you just want to make sure, as a buyer, I'd want to make sure, if that was my customer, that they have some type of long-term commitment with you, because otherwise, that'd be really tough, unless you had a really good relationship and you could talk to the customer prior to purchasing, or you felt really good, which there's no feeling good. If it's written on paper and you have a contract, then you're good. Like if you have a long-term contract and you're buying a business, then you're in good shape, and that lowers the risk of the customer, going to a competitor.
Yep. No, I agree. And, we tried to do our diligence, with our sellers to kind of put ourselves in the buyer's shoes,
Right.
And try to get an understanding of, hey, what is this business's customer mix and concentration like?
Right.
So, 30 to 40%, is definitely on the higher side. I would say, from what I see from buyers, like they kind of get scared if it's even 20%, right?
Yeah, I could see
now,
that.
again,
Yeah.
it depends on the size of the business too,
Right.
of course, and the cash flow that's being generated. But,
Right.
For the sellers to kind of like prepare themselves is like, hey, if you know that you have a high concentration client, then you're going to want to try to have a long-term contract with them.
Right.
You're going to probably be expected by the buyer that client making up so much of the revenue and potentially cash flow of the business, that there might be some sort of stipulation around the payment or value received from that particular client, right? So there could be like a forgivable seller note. It could be like an earnout based off of that client staying for their contract term or until a renewal period or whatever the case may be. But this is a way for the buyer to basically get comfortable in paying for that value that's there with, by limiting their downside, right? And it's gonna, I think, help them get comfortable knowing that the seller's got some skin in the game, that they're going to effectively transition, that high concentration client, because they're ultimately want to get paid, the value for that client. So, and looking at, also kind of playing into the customer concentration and, like looking at the AR that the business has outstanding, right? Because if you have, clients that aren't good payers, right, then that's risky for the buyer coming in like, hey, like this client's been around for, maybe it's a short period of time, maybe it's a long period of time. But like how often do they pay on time? Like what's outstanding? Like you have a problem collecting your receivables. And I would imagine that's something that your team actually helps with. I mean, you guys send our invoices for us, right?
Yeah.
It's all about that, that AR management.
Yeah, that's part of managed accounting. And that brings up a good, I would sort of have a thorough question back at you, because I was thinking about this topic before we had the podcast are there quite a few businesses that you work with that take over the AR during the purchase, or does that sort of stay with the previous owner in some cases, or does it just depends?
That's a great question, Thrine, actually. So it is kind of dependent, case by case. It's I will say, depending on who you talk to, maybe if the business is like value is, right around $1 million or so. And if it's a B2B service business, then there's a high chance that the AR is actually going to stay with the company and with the buyer, or at least a portion of it, because there's usually some element of working capital needs, right? Now, anything that's usually sub $1 million, and I've certainly seen it up to $5 million, where you can have a stock sale, where in theory, a stock sale is conveying all assets of the business, your tangible assets, your cash assets, your AR, your buyer's also taking over your accounts payable. And and then there's like a working capital, kind of adjustment that's made. So you're figuring out, okay, well, how much cash is going to stay in and how much AR is going to convey to the buyer, and how much is the seller going to be able to liquidate, right? Take with that. So again, it's not a hard, fast rule. Just, from what I've seen with my peers, it's as I mentioned. Look, we just closed a business yesterday, which was a B2B service. They were an interior plantscaping company, around $500,000 or so in revenue. They bill regularly, monthly. And, it was a stock sale, but it was a stock sale for the ease of transitioning those client contracts and maintaining the continuity with those customers, right?
Okay.
So while it was a stock sale, there was no cash that conveyed. There was no AR that conveyed.
Right.
The buyer brought in their own cash for their own working capital, and the sellers, sent out their final invoices, and it's their job to collect, obviously, with the help of the buyer.
Right. And I think that's from what you had mentioned, my experiences with my previous life. Family owned an emergency vehicle dealership, and they ended up using an asset purchase agreement. And, we didn't take over, they didn't take over our AR. That was our responsibility. And looking at it, if I'm a buyer, and this is just my personal opinion on it, if I'm a buyer, I don't want to deal with the previous company's AR. Like, I want to focus on building my business and working to build my own AR. Because you're paying, if you're buying the AR, you're obviously buying that probably dollar for dollar, and there may be over a period of time, if something's not collected, then you might get something back, right?
Yep.
Based on the agreement. But interesting. That whole, obviously that's what you do in the details when you're going back and forth between the buyer and seller to what's in the deal and what's not in the deal. That happens over the course of the sale, I'm sure. So,
kind of what buyers look for and ask for first, right? P&Ls, balance sheets, tax returns, obviously.
Yep.
Looking at customer concentration, your AR. Perhaps debt schedules. So they need to know, hey, what debt are they going to be responsible for? So that could be seen on the balance sheet. You might need to provide these loan agreements, right? Because if it is a stock sale, they need to know what the whole enterprise value is, less these debts or liabilities that they're taking over. We know that we need to have financials prepared and clean and well organized for at least 2 to 3 years. But what is the fastest way that sellers destroy the value of their business? Like when, in, organizing their books, like what do you see that you're like, oh my God, I can't believe your old bookkeeper or your old accountant has, been, categorizing things this way or letting you get away with this? Like what are those deal killers that destroy value?
Yeah, I would probably say the main thing is, and I still deal with this routinely, is intermixing your personal and your business in your business, like your personal expenses. Like, that drives me insane when we're looking at trying to fix business books. Now, you can certainly do that, but you want to make sure you categorize it appropriately so it can be stripped out when you go to sell your business. It's not ideal, but you don't want to intermingle those personal expenses that are coming through. You're going out to eat with your family, or that's not business related. Other things that you might be doing with your business that just really aren't business expenses. I would say that's the one thing we deal with the most in training on our customers. But you don't want to do this. Like, if you want to do it through your business, just because that's what you're used to. Okay, here's how we're going to do it. We're going to do a separate equity portion on your balance sheet that's going to be personal expenses. And every time you go out to eat, or when we ask the question, and ideally we don't want to do this. We want to have them really think about it before they pull out their credit card or their debit card when they go to charge something. That's how you want to do it. But if they're just not ready to change those ways, we would literally separate that out in their balance sheet as, pulling out equity, but it's personal. And then when you go to sell your business, you have everything there, and we'd have to explain it to the buyer, like, this is how we do it. And it's probably a little bit harder to overcome, but it's at least it's separated, and you know exactly what that number looks like. So.
Yep, 100%. I mean, I've been doing this for 20 years. You've been, a former business owner, and helping hundreds of business owners kind of reconcile and clean up their books to prepare them for a sale, and we see it all the time. The meals and entertainment, going out to dinner, the personal gas for the vehicles, personal car insurance, all the sporting events. I have a client right now, they literally charge their NFL season tickets to their business, right? Yeah. Another one pays for their personal golf membership, through the business, right?
Right.
So like, we know those things happen. It's just making sure that they're properly categorized. So, we can emphatically, tell the buyer, hey, look, this is for the golf membership. This is for, the NFL tickets that, is not truly a business expense. And you can either, just point them to that ledger, or, hey, it's ripped out completely, and then it gets falls to the bottom line. Right. So that's my biggest thing as well, right?
Interesting.
And I think also looking at, would you agree, like, these, if you have like multiple similar like one-time add backs, like, it starts to like the buyer really just starts to question like why, right? And like, once the buyers like lose trust and confidence in the business and the numbers, like, valuation and negotiations can like literally come to a grinding halt, right? And I've seen it happen. So
I'm sure,
just take the time to do things the right way. Again, you might have had your business for 20 years, and you were able to reduce your tax liability for the past 17 years prior to you going to sell, right? So another thing that I've seen is cash accounting compared to like accrual accounting. Can you explain the difference and like why one business, perhaps like a construction company, might operate on an accrual basis versus a cash basis?
Yeah, I mean, a lot of it is based on a couple of different factors, right? One is the basis of how your taxes are done, and because they have to choose accrual or cash basis, they have to check that box when they're doing the tax return. And most small businesses, do run on a cash basis. Now, and the accrual basis, where you show that you have bills to pay, you show that you have AR, and also recognizing revenue. So like from a construction company, it's, there's certain ways that you should be recognizing revenue, and there's a couple of different ways to do it: percentage of completion, or when you actually do the work, and how that revenue is recognized over the course of that construction project, versus having a retail restaurant, right? And you have a customer come in and they pay for their meal. Well, it's recognized right when that the meal takes place. So it's really important that you have someone who's knowledgeable on your team, whether that be a bookkeeper, an accounting firm who has that expertise within house, or a CPA firm who can sort of understand what's happening and guide the seller and or the buyer, in this case, that the revenue is being recorded appropriately. And that's just the revenue. You also want to, it's also according to the expenses that go along with the project, in the same sort of, it's called the matching principle. So it's in a timely manner, and within the, from an accounting and finance world, it's monthly, right? So you have a close of the month. You want to make sure that's in with that month, and at the worst case scenario, the same quarter, right? Now, taxes, they're normally filed on a yearly basis. So there's a little bit of timing. There's definitely timing involved in that. And you've got to have that basis of accounting appropriate. And I think that's probably one of the toughest part of your jobs, is explaining to some of the buyers who maybe don't have the accounting background, or some of them are pretty savvy, some may not be, but it's probably being able to communicate that in between the parties to make sure they understand that this is how the numbers are, and these are good, or well, these numbers unfortunately are bad. Like let's give them a little bit of time to clean it up before we move forward.
Yeah.
Yeah.
So, aside from like the financial side of things and having like a clean financial house,
Yeah.
what are some other like red flags that stop deals? Like think about, like, I guess like maybe how involved like ownership may be, or their compensation, or like the personnel infrastructure. Like, are those things that you see kind of buyers kind of honing in on, and like what are your opinions of those things?
Yeah, I think the as a buyer of a business, and I've looked at a couple of accounting and bookkeeping firms to purchase over the years, but the one thing that scares me to death is it's just the owner is doing all the work, right? And you can see that they're the ones that taking the most money out of the business and their salary. The owner dependency on a business is not really. It's a business from a personal perspective, but it's not a true business. Like ideally, you want a business that the owner manages, is taking the money out of the business, and they've got multiple, a couple employees, or the business, depending on the type of business and the model. You don't want to be dependent on that owner, because then that's a longer term, what I'll call handover, because the customers are used to dealing with that owner. I would say that would be, I wouldn't call it a red flag. It's just something you have to consider. Red flag might be the right word. It's like a yellow flag. You got to really think through it to make sure that's the type of business that you want to purchase. Again, we already talked about the mix of customers. If you have a high concentrated customer, you want to shore them up with some type of contract before you purchase. And then also when earnings or profit just doesn't seem real in the books, based on your due diligence and go asking questions, and this profit is like, something seems off. And just like you said, when the numbers seem off from the buyer's perspective, they lose faith in the negotiations. You already have that number. It just comes to a halt until they can understand it. You have to have clear and black and white numbers. And I know this is a question you might ask later on in the podcast, but I think it's critical that you make sure you hire. It's okay for a buyer and or a seller, depending on the position you're in. It's okay to hire the right person to help you get your business in shape. Like, just spend the money and do it, especially if it's a big dollar deal, a few $1,000s, to have someone come in and really look over things and be like, do it right. That's small compared to the big scheme of things. So just hire the right people to help you out.
Yep. No, you're right. I mean, as you're entering and exiting a business, you need to have, a solid advisory team, right?
Yep.
To make sure that all your I's are dotted, your T's are crossed, every penny or dollar is accounted for in the proper place, right? I've seen way too many businesses where sellers were just being overzealous with their personal discretionary spending, for whatever it was, right?
Yeah.
Like excessive travel, meals, and entertainment. I think we all understand that sort of thing happens, but again, having it properly documented so the buyer and the lender can validate, and they can see like, hey, this EBITDA or this SDE is verifiable and it's consistent, right? Consistency and predictability is really what drives, kind of values, right? And people are willing to pay a higher multiple for a business where they know that cash flow is consistent, that customer is is consistent and their payments are predictable, right?
Yep.
So look, Thrine, I've really enjoyed our conversation.
Yeah.
We could talk all day long, you and I know we could, certainly over a Caps game and a nice cold beverage, but are there any kind of final or closing thoughts that you would share with any, business owner or business buyer as they're preparing to sell their business or, purchase a business?
Yeah. One of them I already mentioned is don't be scared to spend a little bit of money to get everything in order, because that's look at it like an investment. You're going to sell your business. You're investing a little bit more money to get more on the deal. So look at it that way from a seller's perspective. One, the other two is, you rather have to have 5 financial people, I think, in your tool belt. You need to have a tax accountant, which you're bringing on in your next episode, which is great. And they do a lot more than just taxes, I can assure you. You need a good bookkeeper or an accountant that does keep your books clean. Ultimately, a fractional CFO. Payroll is really important too. You need to know someone who's really good with payroll, because payroll is a intermediate level accounting practice, and that's something that's really important. And then obviously a personal financial advisor. You got to have someone who can help you make sure you advise on the personal perspective, even though it's your business, because that is ultimately your personal goals. And then the last is you've got to have a broker or an M&A advisor like yourself who knows what they're doing. You've been doing it for so long. You got to have someone who can communicate well like yourself and help you through the process. Those are adding you and make it 6, right? 6 really critical financial expertise that you need to have in your tool belt. Now some of those, there may be 6, particular people. Some of them may be one firm that might have 3 of them, right? But you'll know in the firms that you go with that have those multiple, you're not talking to just one person. You're talking to someone else within that firm because they have that expertise. So that's my last. That's my advice for the sellers out there.
Awesome. Thanks, Thrine. I appreciate it. And for the audience, if you would share your business name and website, how can they get in touch with you? Email, telephone number? What's the best way?
Yeah, I mean, our website's coveryouraccounts.com. Nothing exciting. And you can call me personally. My cell phone number is 703-906-4230. Text me, call me. We'll be glad to help any small business out there get ready. And if we can't do it, or if that's not our niche of businesses, then we have a whole bunch of different bookkeepers and accountants that we can refer to. So
awesome. Well, thanks again, Thrine. Until next time, we'll see you back on the horizon.
Thanks, Dustin.
That wraps up this episode of On the Horizon podcast, Buying and Selling Businesses, brought to you by Horizon Business Brokers. If you found value in today's episode, be sure to subscribe, leave a review, and share it with someone ready to take their next step. For more resources and personalized support, visit www.horizonbrokers.com or call 703-910-7384. Thanks for tuning in. See you next time on The Horizon, where buying and selling businesses creates opportunity.